afternoon. Thank you for joining us today for Journey Energy's inaugural webinar with Adelaide Capital. Journey Energy trades on the TSX under the ticker symbol JOY and JARNGF on the OTCQX. With us today from the company is Alex Verge, CEO. There will be an opportunity for questions after the presentation. Please enter them in the Q&A box. The presentation may contain forward-looking statements. Thanks for joining us today, Alex, and congratulations on a great Q1. I will turn it over to you to run through the Journey story and the highlights of the quarter.
Thank you very much, Jessica, and appreciate the opportunity that Adelaide is giving us to present. And thank you to everyone who's listening today and everyone who tunes into this presentation. If I have one thing that I want to really leave you with today in terms of the discussion is I want everyone to see the company as a safe and stable way to invest in the rising cost of energy. We've come a really long way since 2020 in an effort to make the company more sustainable, and we've given it the ability to thrive within the volatile commodity price cycles that we're all experiencing. I also want you to feel that our team isn't really satisfied or comfortable with just being safe for the status quo. I mean, we have a clear vision mapped out to enhance value for all stakeholders. And even though we're always going to put the company's safety first, we're always looking for kind of creative ways to change the game, as long as we continue to get taller and, not fatter. So the theme of our presentation today is unbridled. And I would say the journey became unbridled in 2020 when we, with the help of our largest shareholder and term debt holder, AIMCO, purchased our banking syndicate at a discount. And at the time, we passed most of that discount on to our common shareholders. So I see really three kind of important periods in our recent history as a company that people who look to invest in Journey need to get their head around. First one is that 2020 to 2022 period where we bought out the banks. We emerged from forbearance, kind of creating this Journey 2.0, the journey that exists today. There's a lot of stuff online in terms of podcasts and etc. So, I don't really want to go through that in gory detail, but we did restructure our balance sheet and we did pay down a lot of debt and maintain our production in 21. And then in 2022, we used the cash flow from that windfall and higher commodity prices to make the company really strong financially. The second period was kind of that 2022 to 2025 period, which is the period we're in right now. We announced an acquisition in the middle of 22. We closed it at the end of 22. It was a fairly large acquisition. It did a lot of great things for the company. But over the last couple of years, we've been paying for that acquisition, building a power business, and basically positioning the company for 2025 and beyond. So that would be the third period, 2025 and beyond. All of our assets are central and southern Alberta. This slide gives you some of the key attributes for the company. And I won't go through it in detail, but I do want to draw your attention to kind of the last line of the slide where you can see that we have a $51 million capital program this year. But of that program, only $16 million is growth capital. So I'm going to talk a lot about this, but only $16 million of that capital is really going to maintain or growing our production. We've got a lot of capital going into our power business and a lot more capital going into secondary recovery, water flood and facilities this year than we normally have. So when we talk about this and the impact it has on future years, I think it's important to keep in mind that, not a lot of capital over the last couple of years has gone into growing our production. So talking about this acquisition, we announced it in July 28th, 2022. It was a significant acquisition. It closed at the end of October 2022. It was a great deal. We would do it again in a heartbeat if we had a chance. So at the end of last year, 48% of our proven developed producing value, or about $173 million in value, was attributed to these assets. If you look at how much money we would have had into this by then, well, we would have bought it for $140 million, but it cash flowed $25 million before it closed. So we closed at $115 million. And, over the last 14 months between closing and when we did our reserve report at the end of the year, would have cash flowed again, some more money, and we would have spent a little capital. So the net amount that we would have had into this is only about $90 million. And the way we bought this acquisition, we bought it had very minimal dilution. We only added 3 million shares at the time we bought it. Essentially, this is a really long life, stable decline, low decline asset base. And with these lower decline assets, we use the asset's cash flow essentially to pay for itself. And so, we weren't worried about that because the vendor take back that we did with Enerplus, who we bought it from, was $45 million, but those monthly principal payments were tied to the price of WTI. So when the price of WTI moved from about $100 down to about $75, our monthly principal payments dropped from $4 million a month to $2 million a month, and we're able to easily maintain that production. So that gives you that payment. So that gives you an idea of how we tend to look at these things in terms of trying to keep the company safe, but also trying to maximize shareholder value by not printing too many shares when we do this kind of acquisition. So, because of that, we wound up having a little bit more debt at the end of the year, 2020, at the end of 2022, and we'll talk about that in the next few slides. But one of the key parts of this acquisition, it was probably about 80% of that acquisition, was the flagship asset in Medicine Hat, 72% operated, large field, glauconitic production. We have 34 undrilled locations currently identified. We drilled 4 wells in this pool at the end of last year, and we drilled 4 wells in the first quarter. So we've now drilled 8 wells into this pool already, and we've essentially proved up the entire development wedge. On this slide, you can see some areas that were currently being polymer flooded. About 20% of the field is being polymer flooded. We plan on flooding probably up to 80% of that field over time. You can see some orange boxes on that map where we're moving polymer injection this year, and there'll be more movement next year. You can also see the darker green wedge on the production graph. You can see in the lighter green wedge that Enerplus really hadn't spent a lot of capital on this asset, and it was a really nice stable asset, but they hadn't spent a lot of money on it. And now you can see the journey started to do some drilling in there, and you can see the impact that we're having on this long life production. So one thing to highlight here is that the asset itself is WCS weighted. And when you look at what happened in January, I mean, oil in January oil popped up from about $79 in January to about 85 in April. I mean, now oil's back kind of to 80. But the key thing here is that the differential, because of the Trans Mountain Pipeline, dropped from about $19 US a barrel in January to about $13 a barrel US, and it may even go lower. So with that lower differential, that's about $9 million per year of incremental cash flow for just the 2 properties that we have that are WCS weighted, Skiff and Medicine Hat alone. Those 2 properties are producing about 2,200 barrels a day.
Two questions I wanted to ask, because Enerplus hadn't spent a lot of money and you started to grow the assets a little bit. Where do you see this kind of being the peak production from a drilling standpoint, and then stay flat with your polymer and water floods?
At the end of the day, you could probably ramp this up. Like, it's 2,500 gross barrels a day now. You could maybe ramp it up to 3,000 or 3,500. The key thing here is that these wells will come on and then they'll come off fairly quickly because of lack of pressure response, unless you are realigning the injection and adding water flood. So at the end of the day, the way I look at this is it's more of, if you can grow this acquisition from just over 2,000 barrels a day to just over 3,000 barrels a day, you create a massive amount of value, because your discount here, your decline is going to be sub 10%, because it's not only just growing it, you grow it to a certain level and then you maintain that level by working the water and the polymer around. And so when you look at our development wedge on this property alone, I mean, we probably have a PDP value at the end of the year about 120 million on this, but we have more than 60 million in development capital. So, we can basically just continue drilling the rest of these wells and, converting wells to water injection, converting some water injectors to polymer injection, and just do that and basically add another $1 a share. in PDP value to Journey over the upcoming years. So it's one of our lowest risk, easiest adds that we have in the company.
What is the response time on the polymer flood?
I think it'll be about 6 months to start. Again, if you look at what we're doing this year, we are taking 4 or 5 injectors off polymer and moving it to 4 or 5 new injectors. And then we're also taking a number of production wells, 4 production wells, and converting them to water injection. So when you look at this portion of our budget this year, that is what I would call polymer facilities, secondary recovery capital, like in Massillon and things like that, it doesn't add to our volumes this year, but it will add to our volumes next year and the year after, and for many years to come. And what it's all about here is just using some properties to add higher volumes immediately through drilling, and then taking those volumes as they come off and basically mitigating those declines through secondary recovery. And we'll talk about in the presentation later on how many of our properties have, how many of our properties are under secondary recovery, but you'll find it's probably more than 3/4 of our properties are under secondary recovery.
Hence your 13% decline, right?
Yes. That's right. So I think it's important to spend a bit of time on our business plan. On this slide for the business plan, I don't have 2020 in here, but I'll tell you that our debt peaked in April of 2020 at about 132 million. By the end of this year, our debt should be ultimately down to about 35 or 40 million. So, we've dropped, over that period about 100 million in debt. We've increased our production over that period, largely due to this acquisition, but from about 9,000 BOEs a day to about 12,000. We've also increased our inventory. We talked about the Medhap property and how that increases our inventory. We've added 2 power facilities, which I'll be talking about, that are going to be worth, over 80 million dollars. We've added a Duvernay play, which ultimately may be worth 300 million when it's all said and done. And we did all of this with the addition of only about 15 million new shares. So, as I talk about this, I really want to talk about how we are positioning the company for 2025 and beyond. We have a sensitivity table in there. You can see that we are, a 10% move in the price per an MCF of gas is about 0.8 million in cash flow. A $1 move in WTI is about 2.1 million in cash flow. As you can see, for 2024, our cash flow is highly sensitive to the price of oil. I think that's going to continue to some degree, but over the next few slides, I want to take you through everything we've done to position Journey for rapid but sustainable expansion in 2025. So, let's start with the power business. We put on our first power project at the start of 2021. That's this 4 MW power plant down in Kaunas. This year, we're in the process of expanding our power business to 34 MW from 4 MW. It's taken a bit longer than we originally budgeted due to the challenging regulatory environment, but that's a process that's outside of our control. But I want to assure everybody it is happening, and these plants are going to be on, and they will be contributing revenue for us in 2025. And this is really important. And, maybe Journey's lost a little bit of momentum due to the delays in this, but that just means it'll be an even bigger catalyst for reevaluation at the end of the year when these do come on.
What were the delays a function of?
They're all regulatory delays. We've had Gilby approved for a really long time, but there's a number of different people that we need to deal with. We need to deal with AESO, then we need to deal with Fortis, we need to deal with APIA, the AUC, the Alberta Utilities Commission. We need to deal with a lot of regulatory bodies to putting these on, and it is a fairly complex process. What I will say is that in general, these are going onto the distribution grid. And the way the system was basically designed, it was designed to go from the big power plants to the transmission grid to the distribution grid to your home. It wasn't necessarily designed to flow the other way. So a lot of the things that need to get put in place are things to protect the system in the event of an upset. So these plants need to be, wired into the system so that they can instantly turn off if there's any kind of upset in the system itself. And the regulatory process is fairly complicated. I do feel that is the disadvantage to putting these things on, but the advantage once they're on. This is why, if something is difficult to do, less people are going to do it, and that is just going to mean that the ones that are there, the ones that are running are going to become more valuable over time. So, one of the things that you could ask is kind of, why are we doing it? Why isn't everyone doing it? Is it a distraction from our business? Our drilling is a higher rate of return business. Our cost of capital is lower than that of a utility. So I think I have a slide here that can really identify why we're doing it, why it's not a distraction, why it's a sustainably good piece of business, which basically positions the company well to continue growing while maintaining and making that growth more sustainable. I think we have the exact right asset mix to make this work, because we have some areas where we have excess gas production. We have other areas like our oil pools where we consume a lot of power. So we consume a lot of power per BOE because we have water injections, secondary recovery, a lot of those things. So as I mentioned, the regulatory process is long. It can take up to 2 years. If you stop in the middle of these projects, you need to start over at the beginning. So once you're going in these projects, you really don't want to stop. You want to continue to have them on. So that's why, even though 2023 and 2024 is tight for capital, we're in the middle of this process. We're going to finish it off, and we're going to reap the benefits of it in 2025. So if I can explain this slide, the part to the left of the dashed line is kind of hypothetical. The part to the right of the dashed line is forecast. So what you can see here is Journey's fuel and power costs on the red line, actuals up until kind of the end of the year, and then a forecast beyond that point. What you can see in the dashed light brown line or mustard colored line is what would have happened if all of these power plants were on January of 2021 and they were running more or less 80% of the time. How much power revenue would we have generated during that period where we incurred those actual power and fuel costs? And then we take the GLJ AESO forecasted power price and their gas price and their forecast of carbon tax and the way they've modeled these projects, and we forecast that out into the future. And what you can see here is that our power business is more or less offsetting our biggest cost, which is our fuel and power costs. And to put this in perspective, back in 2020, our fuel and power costs were about $5 million a year. In 2022, they were about $22 million. Last year, our fuel and power costs were about $20 million, but if you annualize just the fourth quarter, they would have been 14. So you're seeing a tremendous amount of volatility in these costs. I believe this volatility will continue over the longer term as we start replacing, like we're almost finished replacing coal. We've got about 7% of our grid now on coal, but it will eventually replace that. Wind and solar is moving up. It'll probably move up to 40% of the grid by 2030. And with that move up, and with the fact that those aren't base load, there's always a lot of volatility in pricing, especially on a cold day when the wind's not blowing and the sun's not shining. You got huge spikes in the price of power. Those spikes can really create a problem on any business plan and your ability to be able to plan. And so now we've set this up so that we've offsetted our largest cost with a revenue stream.
And this cash flow should receive a much higher multiple than your regular E&P business. So
yeah, I believe it should, because essentially it's cash flow that doesn't decline. And it
Exactly.
depends on your future view on power prices, but in my opinion, I think it will. I think it should, it should trade at 7 to 10 times cash flow, more like a utility
That's
than the
exactly
rest
it.
of the business. Yeah.
And just to take one step back before you move ahead on the power
Sure.
side, just your all-in costs, if we could just move back to the slide on slide 8. I think it's key to highlight your all-in costs for all of your power plants are like the capital that you have here, etc. That is your all-in cost that will yield you the 90 million in NPV value, correct?
So when I say that these are worth about 90 million, that's more or less taking the GLJ forecast for power, for natural gas, for carbon tax, for maintenance capital, and basically plugging that all in at the end of the year with all of these on. So that's kind of a 90 million moving forward. When we look at how much we spent to get that $90 million moving forward, I mean, Countess, we spent about $7 million on it. That's already more than paid for itself. Gilby, we're going to be spending about $21 million or so on Gilby to get that. We're going to be spending only about $12 million on Mazeppa to get that. The reason Mazeppa is so cheap is that this is a power facility that was built by Lexon, and it ran about 7 years ago. It was on the edge of the Mazeppa gas plant. It was built for $31 million, not counting some of the grid connections, some of the other costs. And it ran for about a year, and then the Alberta Energy Regulator, the AER, shut down Lexon and basically started dismantling their assets and abandoning their wells. This was one of the last things that was left intact. Like I say, it ran right up until the time when they just physically shut it down. The grid connection is there, everything's there, it's all built. And so we were able to purchase this at about 1/6 of the replacement value. And we bought that at the beginning of 2023. We committed to buying it in November of 2023. We started looking in November of 2022. At the time we bought it, we immediately started looking at reactivating it in place. And it basically, it took all of that time to do the high level studies. By the middle of the year, it looked like we could reactivate it in place. So we put it into this new way that they have of evaluating these things called the cluster study last September. We're going to get the results of that study in June. That will give us a little bit more detail on when we can bring it on. But we're highly confident right now that we can bring it on in place where it is and just basically buy gas from an ATCO meter station and use that gas to run the facility.
Okay, great. Thank you.
So we've talked a little bit about the power business and how it's going to offset our last. That's one of the key things, and there's a couple of key things in the steps that we've taken over the last couple of years to position the company for 2025. So at the end of 2022, with the brand new acquisition, we had about 100 million of debt. We retired about 40 million of debt in 2023. We're going to retire an additional 20 million of debt in 2024. So by the end of this year, we should have about 35 to 40 million of debt. That debt was largely now covered by a convertible debenture that we issued in March of 2024. We closed it on the 20th of March. That basically terms out that 38 million of debt to March of 2029. So at the end of the day, if you look at 2023, we had to pay down 40 million of principal debt. Part of that was AIMCO term debt. Part of that was the Enerplus vendor take back. After we raised the convert, we finished off the vendor take back to Enerplus. We paid down a balloon payment to AIMCO. We have some payments to AIMCO left. They'll all be done by next April. But the key thing is by the end of the year, our net debt will be about the same as this convert. And that basically means in 2025, we're not anticipating any significant principal payments to our debt. So this year you're paying down 20 million of debt. next year you're not paying down 20 million in debt, you're paying down no debt. This year, we're spending about $17 million of our capital program to bring on the 2 power facilities. Next year, we'll be getting 15 million of revenue. So just looking at those 2 factors alone is about a $50 million swing in the amount of capital that we have. So that 16 million of growth capital that I talked to can grow up to 55 to 65 million of capital next year in terms of growth capital. So it's a dramatic change for us in terms of the amount of money that we're going to put back into the ground to grow the business. And, one of the key projects that we're going to use to grow that is within the Duvernay. So
Congratulations on that deal as well. Yes.
thank you so much. Obviously, we're very proud of it. What we're really proud of is that we were a first mover in this play. Years and years ago, we wound up farming out. We built a big land block, but at the time, Journey was extremely small, and we weren't, capable of funding the Duvernay on our own or even participating to a high extent. So we did an extensive farm out and sold down our interest to a company called Queetno. Queetno came in, drilled a number of wells. At the end of the day, I think the execution wasn't quite there. They pivoted to another project. Some of those lands expired, but they did leave us with 3 what I would call basin leading wells or really good wells. And so last year we went out and we accumulated basically some of the lands that expired, and we went and got a lot of them back and accumulated within about a 50 section block in and around those 3 key wells. We accumulated about 34 net sections of land. And so because of that, we were able to take this great land block and say, okay, we're going to develop this on our own, but maybe there's a better way to develop it than developing it on our own. So the way the land block worked is some of our lands were 100% lands, and some of our lands were in that Queetno joint venture. Those lands were about 37.5% Journey, 62.5% Queetno. Late last year, Queetno sold their interest to Spartan. So Spartan had lands right in the middle of our block. So we just put everything together with Spartan. They put some of their other lands in. We put our 100% lands in. We put all the joint lands in. And we were able to build a joint venture. It's about a 128 section block. Both companies currently control 94 sections within the block, and we'll try and get the remaining sections that we don't control. We've got these great wells. Identifying the play in the middle of the block. Part of the benefit of having this convertible debenture was that we had some money to now spend. March 28th, after the closing of the convertible debenture, we announced some guidance changes, and those guidance changes, as we said, we're going to go up from 40 million of capital to about 50 million of capital this year. Now, in hindsight, after the 7th of May, we announced the joint venture. It's clear where that capital was going to go. We're planning on drilling 2 wells before the end of the year with our partner. So the current interest in this block are 37.5% Journey, 62.5% Spartan Delta. Now, there's obviously a lot of work to do here, but there's more than 50 Duvernay wells into the play already. So I think there's very little geologic risk. I think there's very little drilling risk, and I don't even think there's a lot of completion risk in the play anymore. Where we're at in this play, in this stage of development, it's all about economics of scale, logistics, being able to drive the cost down. And that's why, in my opinion, it's better to be a smaller piece of a bigger pie to take advantage of these economics of scale. At some point, probably towards the end of 26, like if we drill 2 wells into the play this year, maybe we drill 6 to 8 wells into the play next year, another 6 to 8 wells into the play in 2026. By the end of 2026 or sometime in 2027, this play could largely become self-funding, and all of the new capital that the play starts to consume will be paid for through the cash flow from these existing wells. And on top of that, we have a lot of infrastructure for the Glauconitic over and above this Duvernay. So, I mean, we have a great place to take the gas, the solution gas that's produced. We have a lot of infrastructure in the area. So, we've attached some single well economics here, and you can see that, this is extremely meaningful for Journey. We're anticipating the capital for these wells to be somewhere between 11 and 13 million each. That's 2-mile horizontals. Again, I believe that capital is going to come down over time. But, our joint venture lands from a net perspective to Journey will support about 60 net locations. And, the first 2 wells that we'll probably drill between now and the end of the year might be between the 2 wells that are on the northern part or sort of in the central part of our land block and the 1 well to the southwestern part of our land block. So between those 2, if we drill 2 more wells, you can probably book a lot of offset locations. So we're really excited about the Duvernay play and the future it holds for us.
And I think of note, there's nothing in your reserve report at all for Duvernay. Correct?
Yeah, no, after the last joint venture, we had essentially all of that land had expired and we had just got it back. We chose not to book anything this year. What we would have booked is a 30% interest in the 3 wells that are on there. So that interest is still in there, but none of this upside is booked in our reserve report. And when I talk about our inventory of kind of conventional projects, none of this is even in that inventory.
And of note, there was a large land sale where surrounding your areas of operation, where would give you about a 50-cent per share value, I think, just on your land value alone, nothing without any reserve value.
Correct. If we go back to the March 20th land sale, and we were interested in that land as well. About 60 sections of land changed hands in and around our block. Some of those lands wound up in our block. Some of those lands were purchased by Spartan Delta. Some of those lands were also purchased by, I believe, Baytex. I believe Baytex announced it as part of their quarter and put a map in their corporate presentation. The Baytex purchase was about $1 million a section for about 30 sections of land. So as I mentioned earlier, we have 34 net sections. So, I mean, that does create a $34 million value for us, but, a year ago, that might have been 5 million. Now it's 34 million. If we sold down our interest and participated at a very small working interest, we probably could have got that value up to 75 or 90 million. But now, if we participate the way we are in the joint venture at a 30 to 37% interest, I believe that value could ultimately be worth 300 million net to Journey.
Yeah.
So we've really tried hard to say, hey, we love the play. We're a believer in the play. The play is economic. There's very little risk. We don't want to sell down our interest. We would much rather have a smaller piece of a bigger pie where we're not exposed on like one well event. So we, as a little company like us, we don't want to go in there and drill $12 million well and then have it not work out. We'd rather drill 30% of 6 wells than 100% of 2.
No, it's a perfect situation for a company your size.
Yeah, it is. And Spartan's an excellent operator and they created tremendous value for shareholders.
Yeah.
So, I mean, if we summarize where we're at right now, I mean, we're all set up to grow in 2025, more growth capital going into the business. We've reduced the risk moving forward with our lower leverage levels, our termed out debt, and our revenue from power offsetting our biggest cost. So the next step is really to talk about the value proposition moving forward. The current share price is an entry point. And so we'll start that discussion by, here's our year-end evaluation. I'm going to tell you why I think it's conservative and why I think there's upside to that year-end valuation. But there's one interesting point at the bottom of this slide. Journey's enterprise value, April 1, is $258 million. I talked about that Mad Hat property. I talked about the development wedge. If you look at the full value of that Manhattan property with the development wedge, and you look at our power business, that alone is more than the $258 million. So, you get the 10,000 barrels remaining for free, you get the conventional development wedge, and you get the Duvernay for free. So, I'll talk about that, but it really does speak to the value proposition of Journey. Now, when we look at the pricing in the reserve report for natural gas prices, the strip price is dramatically increasing over time. If you look at the price of oil, the strip price for oil is actually backwardated, so it's decreasing over time. Reserve evaluators try very hard to mirror the strip price over the near term and then kind of revert to their longer term view over the longer term. If we look at what the evaluators were trying to do at the end of the year, you can see in here 2022, the anomalously high pricing we had in the middle of 22 and what it did for us over the course of the 2022 year. You can see where we came in actually on 2023. You can see that price is in April of 2024 hit a high of $85 and now it's 80, and you can sort of see our budget in there. And then you can see the green line. And the green line on that chart is where GLJ has valued this pricing. So you can see that GLJ is forecasting the price of oil to remain where it is till at least 2028, to remain kind of at where we're at now or even lower than where we're at now until 2028. So that's 80% of our revenue in the reserve report. I do feel strongly that there's a lot of value. And I'm really only talking even about PDP values here. And none of our Duvernay and none of our power business is in that. So when you see this growing net asset value per share slide, you can see where our PDP value is relative to where we're trading or where we were trading on April 1st. And you can see that we're trading at about a third or less than a third, even a quarter of our 2P value. And our 2P value will include the value for the power, but it won't include any of the value for the Duvernay. So we create a lot of value for shareholders, and some of that is commodity prices. But, some of that is also the fact that we did an extremely accretive corporate acquisition and we financed it very creatively, and we let the acquisition pay for itself because it had a long, stable decline. And there is quite a few companies out there that are growing their PDP value per share and they're growing their 2P value per share, and they're doing a good job of that. But what's different for us with what we've done over the last few years, with what some of them may have done, is that we are growing our net asset value and we're increasing our production per share, but we've done it without increasing our corporate decline because we did a lot of it through an attractively financed, low decline growth acquisition. And that's what's driving our growth in net asset value. So we increased our PDP value, but we did it without increasing our corporate decline. And, so why that's important and why how this works through as a value proposition is you've got companies that are on the high end of that curve, on the top curve, which is the decline, basically the corporate production decline rates per year. So if you're one of the companies that are higher end of that curve, you may be trading at, let's say all of the companies on that curve are trading at 3.5 times cash flow. Well, the PDP value for some of those high flyers, which has more than 30% declines, maybe only 2 times their cash flow. So they may be trading at a premium to PDP. The guys in the middle of the curve, if they're trading at 3.5 times cash flow, they're probably trading closer to PDP because they've got, kind of a medium grade or 20% decline. With Journey, with a sub 13% decline, our PDP value is actually 5 times our cash flow because our cash flow is so stable and such a long life. And because of that, we're actually trading, as you can see on the bottom curve, at a significant discount to our PDP value. So we have a lot of the great attributes of some of these other higher flyers in that we've got a higher growth rate, we've got this emerging power business, we've got this Duvernay growth play, we've got this Medicine Hat development, we've got all these great things happening, but we're trading at a deep discount.
Not to mention your tax pools.
Yes, no, and
That's
we
for
do.
something as well. Yes.
We've had, we restructured the company back in 2014 before we went public, and we tried really hard to make sure that we kept all of those tax pools moving forward. And Journey is in a very, very good shape in terms of our tax horizon. The other point I want to make, and that's just, I believe that we're changing our commodity price environment. Now, I'm not necessarily forecasting a giant commodity price super cycle, but I do feel that from the start, the blue line at the top of this chart is January 1st of 2015, the commodity price in the reserve report. And commodity prices dropped year over year from January of 2015 to January 1st of 2021. So we're in a declining commodity price environment. Since January of 2021 till the start of 2024, I believe that we're in what I would call an inclining commodity price environment, where each and every year the commodity prices have either stayed the same or close to the same, or they've gone up. So, in my view, in a falling commodity price environment, you want to own the low cost operator. In a rising commodity price environment, you want to own the most barrels under management possible for each dollar that you invest. And so if you do the math, that's us. Just kind of concluding the last few points. We have an extensive inventory of projects. Again, this doesn't include the Duvernay. This is all in conventional fields. The beauty of it is that we don't suffer any decline, loss of land, because it's all in existing pools. It's easy stuff. It's exploitation in resources that are already producing. The best place to find oil is where you've already found it. You can see the projects that we have here. You can also see that only about 40% of our upside is booked in the reserve report. If you work that through, it's about $600 million in booked and unbooked projects. And for each dollar of future capital that we spend, we generate about $1 in $1.20 in NPV value. And that's at 3 consultants average year-end commodity pricing. So extremely high rates of return. And, if you map that all out over $600 million of FDC, I mean, it's up to $700 million of value, or you literally $12 a share in future value. So you've got a lot of future value in the conventional inventory. You've got a lot of future value in our power business, especially as we move that from kind of a 2P value to a PDP value and future value in the Duvernay. And, we talked about our declines. The reason our declines are so low, you can see that in our conventional fields, we have 1 billion barrels of oil in place, and 3/4 of that is under water flood. And we also have a significant chunk of that is not under water flood yet, but may be under future water flood. So again, as we put more things under water flood, as we take things that are currently under water flood and polymer flood them, we're basically mitigating those declines over time. And then the final point is, if you got 1 billion barrels in place and you're going to leave 85% of it behind, and you do think that maybe you're in a commodity price super cycle, over time, all of that's going to become more valuable, and all of these projects to extract more oil out of these old legacy pools are going to be more valuable. And we can double our PDP oil reserves by just getting, another 3% or 4% more recovery factor. So, in conclusion, before I open it up for questions, I think what I'd like to leave you with is, obviously none of us know what the future is going to hold, but in a rising commodity price environment, in my view, it's rates for show, but reserves for dough. And the barrels under management really matter. So, our business is to provide shareholders with growth on a per share basis over the longer term, and to provide you with more and more barrels under management. And, if you see something that's currently really, really cheap in terms of the number of barrels you get per dollar you invest, and something that has a proven low risk development plan, and something that is poised for commodity price expansion. Then you add in a very sustainable revenue stream offsetting their highest cost, and then a play which is extremely valuable and will become self-funding over the period of the next 2 to 3 years. You wind up with a very compelling story, and that's our story. And I'd like to open it up for questions now.
Okay, thanks, Alex. Appreciate it. I do have a few questions for you. The Duvernay is an expensive area to drill. The reserves are, I mean, quite good, and the IRRs are good. But at what price do you feel is not economic to put a lot of capital into that, Larry? Not, I'm actually, I think we're in a
Yeah,
we have 40% renewables either for our grid, but this is for someone who, wants to see the downside.
we have a sensitivity table in the presentation. You can go through that sensitivity table and you can see the impact of commodity price on Journey. From my own perspective, like, to me, it's not really a question of whether or not the Duvernay economics. Obviously, the Duvernay economics get more challenged if you push the price down to, call it $60 a barrel, or
That's what I'm asking.
whatever that number is. But the reality is that it's a longer life prospect. I mean, if you've got 60 net wells to drill over the next, 15 years, and you're going to drill, 2 net wells this year and 3 or 4 net wells next year, you may choose to strategically devote capital to the Duvernay rather than devote capital somewhere else, even if the prices go down. But what I would say is that, you're going to be constrained on your overall capital budget by the cash flow that you have in the company, unless you want to rapidly start increasing the debt. And we've come a long way, and we've finally got the company to a point where the leverage situation is extremely comfortable. And I don't think there's anybody that wants to go out there and just spend a lot more money in a falling commodity price environment to ramp up drilling. So from that perspective, I think there are other things that you would choose to spend your money on. But the Duvernay may be one of those projects that, even though you may have a slightly better rate of return on another project, you may choose to spend that money on the Duvernay just because of how it shapes up the company for the longer term, even if the commodity prices did drop a little bit.
Okay, and just let's quickly touch on your hedging for the year.
Yeah, one of the reasons that I'm optimistic about next year's cash flow, in addition to the power revenue and in addition to paying down less principal debt, is I do think that gas prices are, going to be higher in 2025 than they are in 2024. Obviously, we're experiencing some pretty low pricing right now on natural gas. We may average only about couple dollars an MCF this year. But next year we've hedged about a third of our production, close to 10,000 GJs a day. We've hedged for the entire year, calendar year, at $3.20 an MCF. So, we've already hedged at a number that is significantly higher than we are getting for the actual price this year. So I am fairly optimistic. Next year, we are unhedged on oil. And one of the reasons we've chosen to pay down our debt than to add a lot more term debt is a lot of these term debt providers out there, when they'll ask you to hedge a lot of your production moving forward in the future. And, hedging a lot of oil production, and they want you to hedge, but they want you to hedge your PDP. Well, our PDP is huge. So, I mean, they want a huge amount of hedging, and they want it out into future years, but you're hedging into a backwardated curve. So Journey doesn't have any oil hedges, and we would look at hedging some oil in the near term, but not 2 to 3 years out. We think the upside on oil 2 to 3 years out is much greater than what the strip is currently indicating.
Okay. And one question here. What's the interest rate on your converts, and do you feel they will be converted in the future or brought back as part of debt reduction?
Yeah, our interest rate is about 10.25%. And, as we were
Not
putting in,
egregious, really.
it isn't. As we were putting in the convert, we had a lot of discussions. Not sure how people are aware, but there's only 3 parties that are participated in this convert, and it allowed us to do it very quickly, and it allowed us to do it very cost effectively in terms of the amount of cost that we had to lay out to put on the convert. And we do believe that these players in the convert are going to be longer term shareholders in Journey. In as much as we fought and negotiated on the 10.25% interest rate, we also fought and negotiated a lot on the conversion price. They wanted a good conversion price because they said to me that they fully expected this to be converted, and they fully expected to be long-term shareholders in Journey. So, I mean, starting out, that's the right way to start out. Again, you never know what the future is going to hold, but after about 3 years, if the stock trades at over $6.25 a share, we can force conversion of these early. And we can basically, at that point, I believe, if the stock is more than 6.25 a share, they'll be equity and they will not be debt. And yes, that 38 million may not actually be debt. But of course, if you're working on preserving the safety of the company, you have to look at that as debt until you're sure it's not.
Okay. Are the reservoirs in the Duvernay considered to be unconventional and extremely tight rock and low permeability that is generally exposed to higher decline rates and capital risk? Or are these properties different?
Yes. The question is how tight is it? And where we are, it's overpressured. It's about 30 to 40 meters thick. It is very tight. It needs to be fracked, significantly fracked. That's why the completion costs are high. But the thing to note is, if we went back a few slides, in the second slide on the Duvernay, if we look at those 3 curves on the bottom, those are our 3 wells. The 2 wells in the north, the 16 to 15 and the 15 to 31, those are the 2 wells that are in the middle of our block, and the well to the southeast is that 13 to 2 well. So, I mean, here's the thing. Yes, it's tight. Yes, there's this issue. Yes, there's that issue. Yes, but hey, we've got 3 wells on production. You can see the oil rates. You can develop a type curve. That type curve that we have there in black on that curve is the forecast that you see above. When you see the single well economics above, they're based on the forecast in that black curve. The 3 actuals are the wells that are basically making up that black curve. So yes, it is a tighter shale. Yes,
So you don't have the geological risk, has
it's
that?
all there. We've got 3 wells already in it.
Yeah. So you don't have the geological risk. It's more of a resource play where it just comes down to ideally not overcapitalizing and like as you said earlier, you think the completion technique has pretty much been determined at this point. So it's a matter of how many wells per section, really.
Well, I think it's going to get better. So here's the thing. I mean, when I say it's 11 to 13, does that mean that ultimately the cost per well is going to be well below 11? Of course it is. I mean, if you look at a company like Avesta on the other side of the Leduc trend, they basically drill these wells in 6 well pads. And so, when you've got coil running into one, you're fracking another, and you complete them all at the same time. So, I know we've talked to Baytex, they prefer, minimum 3 well pads. So if you're drilling 3 wells or more at the same time, you're going to save more than $1 million a well. I mean, you've got to build storage for your completion fluids, which can be about 60,000 cubic meters of water per frac. Well, you've got to basically build your facilities for that. If you're using that same water for multiple fracs from the same pad, the economics are tremendous. So in our view, what we like about the Spartan Delta joint venture is if Spartan is a big player in the area, and if they call for services, those services are going to show up. If little old Journey calls, I mean, we don't get the same attention that they get. So that's why being a smaller piece of a bigger pie is what makes the most sense for a small company like us.
Okay, and you would obviously be a good takeout target for Spartan Delta. And given you're trading at such low PDP value, you obviously are a good takeout candidate. This person asking, what price would you sell out at? I mean, I don't think you'd sell here.
No, I don't think you would. And, I mean, that's a really tough question, to answer. I mean, Journey stock is going to be impacted by the macro environment as much as the micro environment, right? So, and the relative valuations of all of our peers are also going to be impacted by those same environments. So, I mean, our PDP value between the end of the year and the end of the first quarter probably moved up about 30 cents a share, just because the prices moved up a little bit between, the three consultants average April 1st price. And so there's going to be a lot of fluctuation in the value of us. There's going to be a lot of fluctuation in the value of the peers. I don't think you can build a company to be taken out. I mean, you can create the right attributes in a company to be attractive to another party, like the power plant. One of the power plants we're building is in Gilby, which is in the heart of the Duvernay. That's where we also own our 104 gas plant in the heart of the Duvernay. And those are also things that will be attractive to people who are looking at Journey's Duvernay play. So, I mean, yes, we can make the company more attractive to be taken out, but we've got to run the company like it's going to be here forever. And that's the way to make it more valuable. And that's the way to actually encourage people to want to look at it more.
That's what I like to hear. Yeah, because you don't want to run it, like you say, as a going concern, you need to look at it that way.
Correct.
So I mean, two of the questions here are lead into my final question. And given, the fact that you do have such a low decline asset base, which, will increase a little bit as you start drilling out the Duvernay a little bit more, but still, your corporate decline should remain very low. And now you have, except for one balloon payment this year, those are behind you. And you have a normal timing on your, like you had just a normal debt structure. At what size and what time do you start returning cash to shareholders, and which way would you prefer to do that versus dividends or buybacks or both?
Yeah, I mean, it's a complicated question. It's a question that was asked repeatedly in 2022 from many companies they were kind of at the height of the cycle, and it was all about return of capital. If you go back to 2022, our debt was about $30 million when we chose to do that acquisition. Would have been an ideal time with low debt levels to say, hey, we're going to return the money to shareholders. But from a Journey perspective, we went the other way, and we actually increased our debt by taking on, a fairly large acquisition, increasing our production 40%. What I will say is that at the time we bought that acquisition, we essentially have had, we've got 90 million into it. It's got 178 million of value. At the end of the day, even without the development wedge is free. I believe that if you can buy an acquisition with those kind of metrics, there is no easier way to create long-term, low-risk value for shareholders than maybe something like being an early mover in a resource play. But there's no easier way to do that. If you do a share buyback, it's not tax efficient. And once you've bought back the shares, that's great. You increase your net asset value through that, but you don't increase your cash flow and you don't increase your sustainability of the business. You've just taken cash out of the system. If you take that cash and you put it into an acquisition or you put it back into the ground, you actually increase the long-term sustainability of the business by creating more cash out of the system. And then if we look at dividends, once they're gone, they're gone. To the extent that a dividend can help you increase or your share price and reduce your cost of capital, it may be a really cost-effective way of doing it. But at the end of the day, I believe that a business that's rapidly growing, a business that has all the right attributes, may be able to trade at the same valuation or higher valuation eventually than the dividend payer. And the dividend may be a bit of a sweetener, but that is not the sole reason, because there's many companies that have a 10% yield and don't have a good trading value. So at the end of the day, my belief is that if you can find a way to grow your business sustainably, I think that's a better choice for the shareholders over the near term. But if acquisitions become super expensive and the Duvernay becomes self-funding and we're just sitting on this wall of cash because we've offset our highest costs with power revenue, I mean, at some point you're going to make that choice. But I would prefer to wait to a point where the Duvernay got more or less self-funding, before paying a dividend. As far as share buybacks are concerned, I mean, it really depends on the market itself. If we keep making the company more valuable and the stock doesn't perform, then I would argue that that's something that you'd have to seriously look at. But again, that is very tax inefficient.
Okay, great. All right. If anyone has any other questions, you can email me at jessica@adcap.ca. And if you'd like a meeting with the company, I can also arrange that. Thanks so much for your time today, Alex, and look forward to hearing more about the story as you progress with all these catalysts.
Thank you very much. I really
Thanks.
appreciate everyone tuning in. I appreciate all your time today. And I look forward to updating you as we continue to grow this company.
Thanks so much. Okay, bye.